You've been told that markets crash when everyone is scared, when panic fills the streets. But that's a myth. Markets don't collapse when everyone is afraid. They collapse when everyone is calm. When the screens are still green, when analysts are still smiling, when headlines still praise a resilient economy. Because real financial breakdowns don't begin with panic. They begin with quiet exits. Today didn't look like a crash day, but something fundamental shifted. A sudden shock to the Fed's leadership, bond yields jumping, stocks slipping, the dollar strengthening, and metals falling, all at the same time. This wasn't panic selling. This was quiet, methodical repositioning. And that single distinction matters more than any headline you will read. Today was different, not because markets fell hard, but because the reaction pattern changed. After the news about the Fed chair, the market didn't behave normally. Usually, bad news creates one clear move: risk on or risk off. But today, we saw stocks down, yields up, the dollar stronger, and gold and silver falling. That combination is rare, and it tells you something deeply uncomfortable. Investors weren't just reacting to news. They were reacting to uncertainty. Markets can handle bad news. They can price in weak data, slow growth, even a recession. What markets hate is not knowing the rules of the game. The Federal Reserve isn't just another institution. It's the credibility engine behind the dollar, behind bonds, behind global risk pricing itself. When leadership at the Fed becomes uncertain, everything priced on future stability has to be reevaluated. That's why this wasn't just another down day. It was a day that changed expectations. On the surface, everything still looks fine. Indexes are near their highs. Commentators talk about strength, resilience, and soft landings. The economy, they say, is holding up beautifully. But surface strength is often where the real damage hides best. Markets don't roll over from weakness. They roll over from exhaustion. The strongest rallies often appear right near the top, because large-scale distribution needs optimism to function. If prices were weak, big money couldn't exit without causing a panic. So, strength becomes the perfect camouflage. Headlines tell you about accumulation. But the flow of money tells a different story. This is not accumulation. This is distribution, slow, methodical, and invisible unless you know exactly where to look. This is where the difference between smart money and public money becomes critical. Institutions don't react emotionally. They don't sell because of fear. They sell because the risk math changes. Retail investors watch price. Institutions watch flows, liquidity, policy direction, and credibility. When those fundamental pillars shift, exposure is adjusted quietly. There are no tweets, no dramatic interviews, just smaller allocations, shorter duration debt, and more hedges. That's how exits happen in the real market. By the time the price reacts violently, the repositioning is already done. Public money always sees the move. Institutional money makes it. If you really want to know what's happening, stop watching stocks and start watching bonds. Stocks are stories. Bonds are trust. When bond yields rise aggressively while the growth narrative remains calm, something is deeply wrong. Bonds don't trade on hope. They trade on confidence. Confidence in repayment, in policy, and in the stability of the currency itself. Rising yields aren't just about interest rates. They're about risk premiums expanding. They're about investors demanding more compensation to hold debt. That's not a stock market issue. That's a system issue. Stocks can lie to you. Bonds rarely do. Then comes the dollar paradox. The dollar rises, and people automatically assume safety. But dollar strength doesn't always mean confidence. Sometimes it means stress is concentrating. The dollar is the global pressure valve. When stress builds up elsewhere in the world, capital rushes into the dollar not because it's loved, but because it's required. History shows this pattern clearly. The dollar often strengthens right before major financial stress events. It's not a shield. It's a warning sign. When the dollar becomes too strong, it tightens global liquidity, breaks weaker systems, and eventually snaps back violently. Strength, in this context, is not stability. It's a dangerous imbalance. This process happens in phases. Phase 1 is the silent rotation, and it's already happening. Global investors are reducing duration. They're shortening their exposure. They're hedging currency risk. They're rebalancing away from concentration without making any noise. The markets remain calm on the surface because liquidity still exists. Prices don't collapse because the exits are controlled and orderly. This phase feels boring. That's why most people miss it entirely. Then comes phase 2, liquidity tightening. Now, liquidity is not money. It's the willingness to buy, the willingness to absorb risk. When that willingness fades, the character of the market changes completely. Bid-ask spreads widen. Market depth disappears. Small shocks start to create oversized reactions. Volatility doesn't rise gradually, it jumps. One headline, one data point, one surprise meeting suddenly moves everything. This phase feels chaotic because the market stops forgiving mistakes. Phase 3 is the most dangerous, confidence fracture. Confidence doesn't break with a market crash. It breaks with subtle changes in behavior. More currency hedging, more emergency language from officials, more so-called temporary measures. Once confidence cracks, policy tools lose their power. Rate cuts no longer reassure anyone. Stimulus packages don't calm the markets. Words stop working. And that's when markets become unstable, not because of the numbers, but because the underlying belief system has disappeared. This is where the Federal Reserve finds itself trapped. If they defend the dollar, markets will suffer. If they support the markets, the dollar weakens. If they protect jobs, they risk their inflation credibility. Every single path causes damage somewhere. Rate cuts won't restore trust if the Fed's credibility on inflation is questioned. And rate hikes risk breaking an already fragile liquidity environment. The Fed no longer controls outcomes. It only manages the consequences. There is no clean exit anymore. And this is precisely why this moment is not 2008. This isn't a housing collapse. This isn't about bad loans hidden on balance sheets. This is a confidence and credibility problem. And those are infinitely harder to fix because they aren't solved with liquidity alone. Trust, once it's been questioned, doesn't return on command. For the middle class, this stress doesn't arrive as a dramatic headline. It arrives as higher borrowing costs, more expensive credit, retirement accounts that swing violently from one month to the next, job security that feels weaker, despite officials claiming a strong economy. This is how macro stress becomes intensely personal. What makes this even more dangerous is that it's not just a domestic issue. Globally, dependence on U.S. assets is being quietly reduced. This isn't announced or celebrated. It's just adjusted. Regional trade, currency diversification, alternative settlement systems. All of these are moving forward slowly and deliberately. Actions, not statements. Meanwhile, the media cycle follows a familiar script. First comes denial. Then comes reassurance. Then normalization. And finally, justification. Each stage is designed to keep public behavior calm, while the real adjustments happen behind the scenes. By the time the tone shifts to genuine concern, the repricing is already done. This is why actions matter more than words. Official optimism means nothing if institutional behavior says the opposite. Markets always move before the narratives catch up. And understand this clearly. This is not a stock story. It's a dollar story. Currencies don't break loudly. They weaken quietly, and then suddenly, they reprice everything that is tied to them. When currency trust shifts, all asset prices reset. This isn't about predicting a specific date. History doesn't repeat on a calendar. It repeats in behavior patterns. And the pattern we are seeing now is recognizable. Sell America is not a headline yet. But when it becomes one, the opportunity to prepare mentally is already gone. Thanks for watching.